Hello, everybody. Welcome to your TraderMerlin show. It is Monday. A boring Monday, but also one of those Mondays where you kind of, I guess it's just this week, we kind of know what's going to happen. It's not like nothing is guaranteed. However, the price action is just the way that people look at all-time highs. It's pretty much a foregone conclusion that at some point, we're going to pop through those all-time highs. We got awfully damn close to it today. We'll talk a lot about that price action today, of course, because we have the lovely and talented Tillie Allison joining us, who has been on the program many times. And, of course, she's one of my regular, I'll call her a co-host at this point in time. Tillie, how you doing today?
Great, Marlon. Glad to be here.
Glad to have you with us. And I noticed your market outlook numbers. I mean, I love it because we are right in that area that you've been spotting since you started that series, which is these all-time highs. We're coming right towards those levels, actually sitting in that nest of all-time highs right now. Really, the only thing we have to go off of at this point is demand levels or accumulation zones that are down below us. How are you mapping out this road ahead as we teeter on these all-time highs?
Well, so far, given that today's Monday and we have an open, we kind of gapped up into the area where we anticipate some selling, but we really haven't seen any aggressive selling. And, you know, it's always said if the sellers were there, the market would drop, you know. So when you compare something like that to a bear market like crude oil, you know, and you see that whenever the selling comes in, the prices really fall. So, you know, if we take a look at the S&P 500 today, and I don't know how many people actively trade the S&P, you know, or use it for portfolio management. But really the goal here is to use the S&P 500 to better manage our long-term portfolio. Because, you know, a lot of people right now are wondering what they should do.
Yep.
And if the market continues to, if the bubble gets bigger, so we're in the biggest stock market bubble in history. Most people don't even know it. And I'd love to find out how many of our listeners and viewers are actively managing their portfolio using the S&P, and how many are just out there like, what do I need to do? Because we know that sooner or later the market is going to have another correction, another like COVID crisis or whatever the crisis will be. And that's why we want to just monitor the S&P 500 weekly so that we see whenever that pressure comes in, it's not too late. You know, if you see a fire, if you will, and you catch it really early, or you're able to diagnose anything early on, it can prevent catastrophic disaster.
Mm-hmm. Yeah, you know, look at, for those of you who didn't see it, if you go out to the TraderMerlin YouTube page, you can check, there's a subgrouping, a playlist, if you will, of Tillie Allison-Harris's market outlook. And, you know, there's a lot of these lines drawn, and it's great because it gives us all the opportunity to do what you should be doing in a trend like this, which is buying and going with the trend. I got to ask you, though, Tillie, as we approach those all-time highs, and for the viewers out at home, you're watching my screen move around, the all-time high for SPY was 339.08, and you can see that last week we hit 338.28, 338.25, and today we had a high of 338.34. So we keep knocking on the door of those all-time highs. What do you do personally when you get a break above it? Because I'm looking at it this way. I was kicked off of CNBC back in 2008 for saying that if we break 1260 on the S&P 500, break out the bulldozers, we're going down in a big way. That was a call before the market crashed. Fortunately, in hindsight, I was correct. What got overshadowed there was also they were talking about gold, and I think they were talking about gold getting to 1200. And I said, you guys, look, it's not about when. It's not about if. It's when, because you, the media, keep putting in front of everybody's face all-time high for gold, and all of a sudden it's like a Ouija board to price. And I think that that's what's going to happen now. I think you're going to see the Ouija board of price bring us to all-time highs. But once we break that, Tillie, then what? I mean, how do you measure targets? Because I know you're a big distribution fan. You have no distribution up above us.
Okay, great. So, like, the best thing that I found personally, I like to work with the higher time frames first and get a plan, and then come in on the lower time frames and micromanage it, if you will. So, for example, the measured move, we call it a measured move. Anyone out there that studied technical analysis, the CMT, you know, going back in the day, you know, my very first training instructor called it a measured move. And so we measure the movement, which means the price range, you know. And I always love to use car stories. You know, if you know a car can go a set amount of speed, set amount of time, then we can expect it to do that again, right? Or a horse race or whatever. So whenever we measure the movement, like on the weekly chart of the S&P 500, there's a most recent accumulation area at about $320 a share. So if you look on the weekly chart, there's a 4 candles rallying out of that base. And in that area, we call accumulation demand buyers. Obviously, whoever bought there at $320 a share, that's what caused the market to be where it is today at $338 a share.
Yep.
And what we anticipate is that roughly $8 move. It's very realistic. It's not totally crazy, for the S&P to rally another $8 above. So say 348. And that just kind of gives us a rough estimate of, so we don't just, buy hoping it's just going to blindly go to 400, without stopping along the way. So we would expect it to pause a little at 348. And, for more active trading, that's really important, because the worst thing in the world for active trading is to not have good targets.
Mm-hmm. I like that you say that, because it's nice to have measuring sticks. And I think that's what you're doing, is you're taking, okay, here is kind of one of the previous moves. We'll use that to kind of anticipate what the quote-unquote waves or cycles are going to be. And I know all the Elliott wave haters are going, oh, it's not about waves. But it is about price movement. What do you say about, there's a lot of traders that are, I would say, fixated. They love things like Fibonacci and using Fibonacci as a forecasting tool and saying, okay, if we break these 339 highs on SPY, then we'll do an extension piece here and target that. Do you do any sort of targeting tools, or is it just purely off of what price has done?
I simply measure one move to the next. So whenever it looks like there's been a bunch of buying pressure come in, I measure it the old-fashioned way. I'm a dollars kind of girl. But Fibonacci is just the same measurement. So for fibs, I've used them in the past, and it's great if you want to break something into ratios. So say you want to try to scale out, and we expect it to go to 348, and you want to take a certain percentage off. Fibonacci is great. We can break it up into 25 percentile fib ratios. We can do the standard 23, 38, whatever, 50, 60, what is it, 618?
Yep.
So we could use Fibonacci, and we could use it anyway. And, if you prefer to have some sort of tool to work with, I just prefer to run the numbers.
Run the numbers. All right. Well, I'm a fan of running the numbers. I don't feel like numbers can lie too often, unless you work for Enron or one of the major financial firms. But this topic for today was separating the bulls from the bears. I made a nice little graphic out here for the show today. And the reason for the topic was this. We've been in an extremely bullish mode since those March lows. It has been one of those rallies that have been historic as far as percentage rates of return since March. Of course, I was betting against it in the middle of that, got burned. It's okay. That was all a plan. If it lost, it lost. I told you guys all about that one. I'm all right with the loss. But we said separating the bulls from the bears, and I think, Tillie, maybe you can help me with this one. We were looking at it from the perspective of, while there's this belief system that the rising tide floats all boats, and this market has done very well, most things have moved up. There have certainly been some sectors and markets that are very weak, and you thought, I like to focus on those as potential shorting opportunities, right?
Well, I don't know about you, Merlin. Well, actually, I do. I know that you're quite active, but I just mean, personally speaking, I really don't know if you do have, kind of a preference of, if we have a list of stocks or groups that are bearish. We're going to increase our odds of probability if, instead of, shorting a bull, kind of looking to see what we can short. And crude oil has been, it breaks my heart, because good friends of mine have, the last few months, they call you, email you, whatever, and they're like, hey, I'm really thinking about crude oil as part of it going long. And I'm like, well, I'm not really thinking about that, because, hey, why don't you be long the S&P 500? And but then for more active trading, if I want to be real active in short sell, I tried to short sell the S&P 500 last, I believe it was Tuesday, and we got a small little move off of that, but that's it. And so we can spend the same commission and try to short a market that's more bearish and earn a higher rate of return. And it is a little bit more work, so everyone loves to trade a lot of assets that we can go long and short both. But sometimes that can cause us to kind of short a market. So, I'm guilty of sin of shorting the S&P at all-time highs and kind of hoping it would drop. Mm-hmm. But then, get a much better move on shorting something like crude oil. And I like to use crude oil stocks like ExxonMobil, Valero, those to really, guide us.
Yeah, no, I'm definitely a fan of finding what's working and what's not working. I've shown this chart to you guys many times, and I don't know if, Tillie, you might use something like this. I know you can't see my chart right now, but you probably will if you're watching the YouTube stream. This is just a sector analysis tool, and basically it's just comparing market sectors together. And I try to put most of the S&P sectors, as you guys have seen this many times on the show. This is going back to January 1st. And while we're looking at this market at all-time highs for most major market indexes, and I saw a comment in chat earlier saying from Joseph saying NQ new highs today, that's almost like saying the sun came out in Southern California. The NQ is making a new high almost every day. It's just ridiculous. But that will change at some point. The reason I love this chart is this black line right here represents the SPY, right? That's your S&P 500. And you'll notice there's only really 1, 2, 3 segments above that. That first segment, which we talked about many times, is technology. That's up 22% on the year. Then you have a subset of technology, which is SMH. That's semiconductors, and I've been following that one for a long time. That's up almost 20%. Other than that, the only one that's beating the S&P is healthcare. You'll notice there's a lot of other ones in here. So the S&P looks to me, it's kind of squished on the screen. Looks like it's up about 4%. But underperforming that, you have consumer staples, which you would think would be doing great in a pandemic. You also have below that utilities, but that's only up 5% on the year. Down 5% on the year. Then you have industrials down 7% on the year. This other black line, talking down 20% for financials, and then of course energy down 37%. On paper, and actually on this chart, it looks like we have more sectors that are actually underperforming and bearish and negative on the year than we actually have that are bullish on the year. So, when you're looking at that assessment, Tillie, is saying, okay, I could buy technology or semiconductors or just the S&P and make money to the upside. How do you play those bearish or underperforming ones?
So, I really like crude oil and the crude oil stocks in there, but really any chart, we want to look at the overall price and see if it's, over the last 3 or 6 months. So we want to really look at macro trends. Macro trends are kind of the bigger moves and determine if it is in a downtrend with lower highs and lower lows. And then we look for those key areas of selling and distribution to try to position short selling. And what I really like to do is to time it with the S&P. So like when the S&P is trading these all-time highs, those markets typically will be rallying into those sell zones as well. Mm-hmm. And we can get an opportunity to position short on there. So if you take a look at ExxonMobil, is a great example.
I'll bring it up for us. Go ahead. Just walk through it and I'll drive. So I got the Exxon on weekly right now.
I was on a daily chart of ExxonMobil.
Okay.
And last week I was actually doing some analysis of the major sectors and looking for, stocks that would meet good criteria for trading. And I noticed here that it had that sell zone, supply distribution area, about $46 a share. And this is a really good example of, kind of what we're looking for. We're looking for a bear market that's in a downtrend. You can see clearly that's been in a downtrend.
Yep.
And to look for rallies, and it'll kind of time with the S&P. So, and like the NASDAQ, Joe mentioned here in the text that, NASDAQ's making new highs again. So the S&P is the benchmark. And then, for people who want to be real bullish, something like NASDAQ technology. And then, if you want to shorten, or buy puts or something, the oil and gas sector, ExxonMobil is a great example of kind of what we're looking for.
I'm bringing it. Yeah, I'm comparing these together. So I'm trying to put two things on top. So, we had, it was John Rowland in the program, who is an oil trader and a natural gas trader, and he was talking about probably the better way to trade this oil and gas is not with the oil futures. You guys remember him talking about that? He was talking about looking at ExxonMobil and Chevron and ConocoPhillips, et cetera, to make that play. And here's why. I'll bring up at CL on the top chart. Actually, it's kind of weird. They're actually underperforming. I actually thought that ExxonMobil would probably be looking a little bit better than it did right now because crude oil is pretty much flatlined, and it looks like ExxonMobil is actually drifting down a little bit. So when you're looking at these, Tillie, are you interested in shorting ExxonMobil, or is it saying I find some undervalued buying opportunities? Because I know how you think for strategic investor and kind of is saying, look, I want to rebalance and buy some more of the weak stuff that's been in my portfolio. Is that how we're looking at this?
So at the moment, it has traded down a bit. It's closer to 42.
Yep.
So, today's lows here are off of that 42.5. So we surely don't want to be shorting, at the bottom of the barrel.
Yeah.
So again, right, we have to wait for a rally. So, off of these lows today, it's pushing higher. And if we look above, I'm actually looking at the chart right now, so you guys see me looking down because my charts are on my laptop down there.
I've got the charts over here, so we should probably go.
Okay, right on. So if you guys look up and like So what time frame are you on there, Merlin?
I'm on a daily. Whatever time frame you tell me what to look at, and I'll draw it.
Yeah. Well, there's area that we want to look at. It's about $47. It's just above that high at 46. So 46 and 3/4, 47. There's a kind of a base drop candle, and it was on June 23rd.
Yep.
So June 23rd, there's a base drop, and anyone, Online Trading Academy is amazing because they've coined these terms, and it's just such a good way to analyze the market and look for selling pressure. So, that's a base candle, a reversal candle there on the 23rd, and prices clearly traded much lower.
Mm-hmm.
They broke a bunch of recent lows. Previously before that, price was, rather strong, off of those highs, and then it just dropped like a rock. So, price fell from roughly 46 3/4 all the way down, to the lows of 41. And, it might be a little while before we get up there. So that was the area that really caused weakness last week. So most recently here, just a few days ago, there is another area that's closer. And these areas are higher risk because it's closer to current price.
Sure.
It's always said if we go further away, closer to 47, obviously, if we sell short at 47, there's more room to fall than if we sell at 44.25. But just a few days ago, up at 44.25 on the daily chart on the 12th of August.
Yep.
And so though the problem is, trying to short here in the middle, you obviously, we don't have as much, it's much higher probability the higher we sell.
Right, and it's kind of range bound too. It's not like you're not in an extreme of a range. You're kind of right at the midst of it.
Yeah. So personally, this is something that if I were referencing a supply zone, a distribution zone area at $44 on the daily chart of ExxonMobil, we would cross reference this with Chevron, with Halliburton, other crude oil companies and in that sector, and look to see if they also have some areas of selling pressure up above. And if we get all that confirmation that the entire sector is likely to sell off again,
mm-hmm.
Then trading something with leverage like crude oil futures, looking for alignment on that would increase the probability. So there's, a pretty high correlation between crude oil futures and the different stocks.
Yeah, and it's, at this point, when we look at something like this, Tillie, I got to ask the question just because it came up in the group here. Mario says long below 40, and I think, there comes a point, and this is a very challenging question, Mario, because there comes a point where we look at price of ExxonMobil. You're like, it's one of the most established oil producers in the world, oil companies in the world. They're not going to go out of business. At what point does it become a value play if you're trying to pull the Buffett card? Certainly, you could look at fundamentals. That may help. But is there a price point, Tillie, where you look at it and you go, you know what? I'm a buyer here, regardless of the big picture of the markets. And I'm going to let you tackle that first because I have a twist on it.
100%. So, yeah, in any product, when something's cheap, for ExxonMobil or crude oil or anything to be trading at 50% of the price that it was, so
mm-hmm.
many months ago, you have to look at this company has a probability of trading at $80 a share, and you can buy it at 40. For longer term investing, it depends on how long we want to hold that stock or whatever for it to return to those highs.
Mm-hmm.
Eventually it can go there, but we buy crude oil or ExxonMobil at 40. And then who's to say it's not going to drop down to 20 and then go back up to 40, and then you're sitting there cycling it down. So the most important thing to have, if we're going to do that, I know it sounds kind of traditional and old school, is not to go 100% allocation all in at any given number unless you're really close to zero. Because, who's to say when you buy it at 40, it's not going to drop to 30. Mm-hmm. And of course, if it drops to 30, you're going to sure be crying because you wish you had bought it at 30. And, they call that dollar cost averaging, of course. And that can get a real bad rap because someone who's buying it all the way down, if the company has a restructuring, if the company goes out of business, that's a higher risk investment. And that's the problem with buying anything unless it's in a confirmed uptrend. That's why I love the S&P.
Yeah. Well, you also have the benefit of such great diversification. I think a lot of people, we heard Joseph talking about the NASDAQ 100, which is great. But remember, that's a little bit biased towards technology, biotech as well. It's funny, when I started, Tillie, when someone said the market, it was the Dow Jones Industrial Average. And you look around the world, and all my world travels, anytime you pull on CNN or any of those other programs like that, they're always saying that the Dow, they always quote the Dow first, where anybody starts to trade for a period of time, you realize that it's really the S&P 500. Or, of course, we could say it's the Wilshire 5000, which is everything, but that includes a lot of little garbage that we just don't care about. So S&P, to me, is the market, and I think that's the most important one to be following as we go through this. And I think that from the investment perspective, from anybody looking at the long-term picture, it's probably best to stay in something like SPY and trade those moves because of that overall diversification. You get stuck in the FANG ETF, and all of a sudden you are biased to a select group of stocks that's going to give you really volatile swings. And there's two schools of thought here. There is the, hey, I could just buy Facebook and be riding this monstrous move to the upside, or Tesla. Or I could buy the S&P and my returns will be much more muted, but I'm much safer. And we all have to make that decision. I think Tillie and I are both in that safety camp when we talk about our longer term investments.
Absolutely. And then though, using a sector group for longer term investing can kind of get us that participation. So there's a few crude oil, like USO. USO is a crude oil ETF.
A garbage one.
That's real popular.
Yeah, it's real popular, but it's a mess. I mean, you look at the chart. Let's look at the at the USO. This is one that the way that they structure it with forward futures contracts, it's a challenging thing to be trading. I don't know. I'm not a big fan of trading USO, but I mean, how else are you going to get into it? There's not too many other places to get into the straight oil unless you buy something like. XOP. XOP would be one, but that's more like producers and refiners and exploration, stuff like that. So, there are different segments we could use that help further diversify the investment risk of it. But I think when we look at that sector picture, it's clear that there is, certainly for the last year at least, a beaten down perspective to energies. And just for giggles, guys, I'm going to zoom out and show you the last 2 years from a percentage basis. So bear with me as I adjust this chart for you. Price percentage chart from this bar. If you go back to 2019, every sector, well, at least the ones I have posted here, and we're talking about financials, we're talking about healthcare, industrials, consumer staples, utilities, technology, and semiconductors. All of those are positive, including the S&P, which is up 35% since January 1st of 2019. Guess where energy is, Tillie? Not good. It's down 33%. I mean, and it's been this prolonged market sell-off, and at some point, it's going to come back, and this is the challenge here. As a trader, you want to short the weak. You want to short the weak and buy the strong. So in this case, you're buying technology, you're buying semis, and you're shorting energy. You got to be very careful here because, again, going long technology is risky because it's already moved so much, and going short oil is risky because it's been pressed down for so long, it could pop back to the upside here. So again, it's all about risk management in these situations.
Yeah, absolutely. So I want to give a shout out. We got some great comments about, some questions and stuff about buying puts. So I do not buy puts on the S&P because I do regular reallocation. So I always say if someone wants a real hands-off approach, if we're long in the S&P and we're not going to do regular reallocation. So, full disclosure, I took some positions off, during this most recent rally. I'm still long the S&P 500. And I don't want to shoot a winning horse, but I also don't want to stay long 100%, full exposure. So buying puts is great if we want to protect any downturn or just use a put for directional, profits on the downside. But I do not do that because I do regular reallocation. Mm-hmm. And I do, whenever the market is down, I actually sell puts. And, call me old-fashioned, traditional kind of girl. But I'm pretty boring when it comes to this. But boring is good for, I like a lot of adventure in life. And I found a long time ago, I'm not going to get that in my trading. So my trading is as boring as it just, everyone out there, you guys wouldn't even believe it's just so boring. We're going to look at the S&P 500 in a few minutes and talk about trading futures using those zones that I've been referencing. Because I'm just looking for consistency.
Right.
I've got a lot of investments that are in all kinds of funds and stuff, so I'm getting exposure and this and this and that. But as far as active management, I want something that's stable. So instead of buying puts, I actually sell periodically. And at Online Trading Academy in Strategic Investing, we recommend that regular reallocation. but then to think about, okay, how can we make some income while we're waiting? And we've talked before on the show about using puts to earn income. So like say we want to buy the S&P 500 SPDR at $320 a share, so all of a sudden the market's down one day, 2%. Well, the premiums on those strike prices to buy at 320 are going to be fantastic. And then for more active trading, so right now we would say that the S&P is range bound. So if you look, Merlin, at the spiders on a 60-minute chart, which is the more active time frame, the zones here that are for weekly analysis, we are trading at 337 and 3/4 roughly. I always round up or down to the nearest quarter. And when you're looking at stocks and stuff, a few pennies here and there on $300-something stock is really nothing. So 337 3/4, and right now it's in a channel completely all day long today. It has been completely sideways. So obviously the first candle of the day opened inside the range of the distribution area that was identified last week. So we're going to call that an inside range day. And obviously anyone who trades actively knows on the inside range day, we're playing ping pong. All you're going to get is, teeny tiny moves inside that range. But what we're waiting for is for it to close, trade above like 339 and a quarter. I'm going to call it 339 and a quarter, which would, even just be a tick above that all-time high area. And looking for a solid base rally, clear as day. You get a base rally and the market moves the full daily ATR. So, like $4 or $5 on the S&P would clearly be a breakout to the upside. And we'd be looking to try to position to join the uptrend as a breakout trade to the upside. But, we're probably not going to get that. Just, always when you walk through a setup, you're probably going to get the opposite. So we've got an open gap on the spiders on the 60-minute chart, and that would be Friday's close at 337 roughly. And so what we'd anticipate is that if prices drop to 337, which is very close to Friday's close, we would then again be looking for a lot of buying pressure to come in, a lot of base rallies, and looking to use that as an opportunity to try to go long. But unfortunately, you're trying to go long up against a bunch of selling pressure. So that creates a much higher risk environment. And usually we trade futures for those real short-term environments. Probably wouldn't be a long-term long position there because you're in a very congested sideways area.
Right. Oh, yeah, I'm annotating as you're going along here and kind of drawing the chart, so I'm trying to make it all visible for everybody out there that's watching. One thing I want to add in here as I go through that, because you're right, we've got an unfilled gap, which I think is critical. You also have this really compressed sideways action right now, which I think is okay. I think you'll see the market break through all-time highs just because everyone thinks it's going to, regardless of market fundamentals. It's just a psychological thing at this point. So we'll probably see it break all-time highs. Then it gets interesting because usually when something breaks through an all-time high, it has a really strong move up because there's no supply, there's nothing above it, and people just go, oh, well, there's nothing above it, it's going to keep rocking. And then it gets kind of scary and really unpredictable. The piece I wanted to mention and go back here a little bit was on the, ExxonMobil. And giving you guys my 2 cents on ExxonMobil just because it's pretty important when you look at the big picture here. Energy's been beaten down. We know it. We've seen the charts over and over and over again. I don't think it's any shocker that at some point you got to think about where's the value and when is the right time to buy into ExxonMobil or Chevron or any of these other oil producers. The big thing you got to keep an eye on here, and this has been the wild card for me, at least for the past few months, is this dollar has been just absolutely falling apart. I will bring up, I think I had it up here. Where's the dollar index? So I'll bring up the Dixie for you. This is critical because the cheaper that the dollar gets, it means the more oil can be purchased, right? It's going to benefit oil. So a weak dollar means you're going to have strong oil. And is this dollar, oops, that's not the right chart, $DXY. Here is the dollar index. This is just on the 60-minute, but take a peek at the daily chart here. We're coming right back into those lows, and those lows were right back to a demand level going back to 2018. If that breaks, we're going to go down to those weekly lows. And here's you can see the weekly lows. They're considerably lower. I mean, right now you're at 92.83 on the dollar. The beginning of a huge demand zone is about $90. So that's another $2.83 drop from current price point. And that, of course, we'd have to get down below 92.24. But if that happens, that's really good for companies like ExxonMobil and Chevron. The tricky part is their charts have not been reflecting that. They've been looking almost the opposite. And I'll show you what I mean here. On the bottom, I've got your dollar index, and here's XOM, ExxonMobil. Their chart should be looking the exact opposite of this. You can kind of see it in the past, right? When the dollar, when Chevron sells off, or ExxonMobil sells off, it's because the dollar was gaining strength. But now the dollar is showing extreme weakness, and it's not budging. That's the only part here that makes me scratch my head and go, God, I'm not sure. This puzzle is not working out the way it normally does. So for those that are thinking about buying energy, buying ExxonMobil or Chevron and these guys, be careful. This dollar at the bottom should really be vaulting prices of these oil companies, and it's not. So I think something's broken right now.
Oh, definitely. Yeah. And, whenever the market is where it is today, there's a lot of things broken. I mean, obviously, I don't think people's home values are up 300% from the lows of 2008. I don't think people's salaries tripled, so when the stock market's tripled and the GDP hasn't tripled, in fact, we've been dealing with the most crazy employment data ever in history, because of this COVID crisis. So there's a lot of things that are not exactly normal.
Yeah, it's broken. It's a very odd time we live in. So anyway, I just wanted to keep people aware of that, because my concern is that we'll have people who are running out there and say, hey, I'm just going to be buying energy because it's been so beaten down, it's going to come back up. And I think that it is at some point. We could all have a debate whether crude oil is just going to disappear and because of alternative energy and things like that. But I think you're talking ways down the road. So could the answer be that there's no demand with regards to oil? Again, that's part of that argument, is that not that there's no demand, but certainly it's a lot weaker. And this goes back to a comment that was made earlier from, I think it was Tom or Big Eb. Was it Tom? And I agree with you, Tom. He says, I'm looking at this bull move as just getting back on pre-lockdown trend. The trend going forward will be based on the stronger businesses that survived this artificial pullback. It's two things. Number one, you are looking at this pullback, right, and saying, let me bring up SPY again, just so we can have that on the chart for reference, and I'll go back to a weekly. You are looking at it getting back to normal. I think that this trend is a bit abnormal. The issue I have with what's going on is the amount of capital that's been put in by our central banks and the government. That's fake. That's fake money. So you're balancing out a whole bunch of fake money in conjunction with a lot of failures of American businesses that we may not really know much about. I think a lot of these will go bankrupt. Some will just disappear. Like you guys told you about the pho restaurant by my house. Those guys are just going to disappear, and that's not going to be a bankruptcy thing. They're just going to dissolve and go away. And I think there's a lot of businesses like that. Which is really sad, because I think, maybe Tillie, maybe give me your perspective on this one. I think what will end up happening here with this whole COVID piece and what it's done to small businesses is the big ones will survive. The mom and pop restaurants that, we all probably like much more than going to your Applebee's or other restaurants like that. They're really great little tiny places that weren't allowed to stay open or are going to get shut down by this, and we're going to be left with nothing but chain restaurants all over the place. So I'm hoping it comes back to small restaurants, but I do agree with you. I think we'll see this market just continue on higher. I mean, there's really no reason other than something catastrophic. It seems to me that the whole COVID thing is going away much, much easier than anticipated, and that will probably boast for a much bigger bull side move to the upside.
Yeah, so looking to buy in, about 337 if we get that opportunity this week. If we get a breakout to the upside, above 340. And then, hey, all of a sudden, if a bunch of crazy selling comes in, there was a great question about the area identified. It was $334 on the 60-minute chart that I mentioned. We could see clearly on the S&P futures, and that's because it did form in the overnight session. There was a great question that says, are overnight zones valid? Right. Well, not yet, but they will be validated. So, like pre-market one day, if the market is holding that 334 area, then we have the validation that it is. Okay, but all what you call it, all overnight areas are validated during the day to confirm they're valid. You have to say they're always low volume overnight because they're such low volume overnight, and then everything gets validated intraday. But sometimes it's hard to get in intraday because there's so much volume. Yeah,
I agree. I'll read the questions because I think it's funny, and obviously there's no love loss here between me and the individual that's mentioned in that guy's message. He's basically some analyst, including Sam, said that on his show that overnight levels are not as reliable. What are your thoughts? And he's right. He's right. I hate to say it because I hate the guy, but he's right because they are less reliable simply because during regular market hours, guys, you have all the volume, right? The swimming pool is full of water. And when you don't have regular market hours, the swimming pool has water in it. I just don't know how much. So when you jump, you might seriously injure yourself. I know it's a really weird analogy. To say that they are irrelevant and cannot be used, that is a false statement. You can still use a supply zone or accumulation distribution, whatever you want to call it, that formed in the pre-market hours. But the reliability isn't as strong simply because you don't know what's backing it. It could be one person like me who just sold 10 contracts, or an institution. You just don't know. Regular market hours, it's going to take a lot more than 10 contracts to stop or to move the futures contract. It's going to take 100, 200, 300, and that's way beyond my scope of my trading. That's going to be earmarked or footmarked as institutional. So I would agree. I would say that they're not as reliable, but you can still use them, and I think you should be using them.
Yeah, it would be terrible if you didn't notice them, and then that'd be a great area. So the real-time data will confirm those areas are valid, but if you don't recognize them, you oftentimes miss really good opportunity.
Yeah. I am for. It's funny. What?
I always say that people out there say stuff isn't any good when they just want to keep it to themselves.
Yeah. Well, I've got no love lost for this particular individual, so I could care less.
I do believe that there are some key times of day that make them more valid. For example, pre-market, before the open, a few hours prior to the open, oftentimes those levels are valid and do create the volatility on the open and are retested soon after the open. But yeah, wee hours of the night and all that stuff, we definitely want to wait for extra confirmation.
Agreed. It's all risk management. I mean, you have to know that trading those pre-markets, there is that added level of risk, and that level of risk is liquidity or illiquidity, right? It's the lack of liquidity out there. So, Jerry, I am no genius. I'm just I'm someone who speaks it real. I'm just tired of people who are yeah, never mind. We're not even going to do on that. We'll take the high road here. All right, Tillie, tell me about what's going on in your world. I know that you are doing some teaching, right? You got some classes coming up here for us?
I do have classes here in Kansas City, and I'm also doing a lot more with Online Trading Academy online activities and things. So kind of excited about that, and looking forward to seeing all of you here on Merlin's show next time.
All right. What are you teaching?
I teach core, the 7-day on-location core. We only have a handful of students in the classroom because we're practicing social distancing. Everyone gets to wear a mask all day. So, it's kind of different. The classes, I think students learn more because with only 6 people in a classroom, everyone gets a lot more practice. And, I would 100%. So the trading in class is, spot on because we don't have too many distractions.
Yeah.
In your classroom, it's kind of harder to herd the cats. And yeah, no cats today because I'm actually at the Kansas City office. There was a chapter about my cat. Go home and be with my cat later.
Let's ask this one because it's a good one. You've been dressing. You have such great style, Tillie. Your weekend edition outfit was pretty awesome. You're looking very stylish today. Are you gonna go back to your runway days?
No, my goodness. No. So yeah, that's one reason I love doing the show with you guys. It brings personality. I told my class, I said, you guys have to check out the show because, as an instructor of Online Trading Academy, our goal is to help students understand, how to manage risk, what's going on, how to plan a trade, to really learn to think a little bit differently about stocks and investing and trading, and then to be able to bring personality to it, because in the classroom, we don't bring a lot of personality. I mean, we do what we don't. We stick into, teaching a skill. So Here we get to have a lot more fun.
Yep. One last question for you. This one came in from GD. Do you look at volume? Are you someone who uses volume as a tool in your trades?
Not so much because I know that the products that I trade are going to have set amount of volume. But if you're trading stocks, it can be a problem because stocks can have real low volume sometimes during the day. And if you want to trade a large position, it can be really hard for those orders to get filled. And clearly we're going to have more volume come in when there's a big bunch of buy orders come in. But you never know the difference between volume is both buyers and sellers.
Yep.
So we expect to have higher volume during news events. We expect to have high volume at, bottoms whenever the companies are, you got a bunch of short covering going on. The short squeezes going on, which are, short positions trying to get out of their shorts. And they got to buy to cover, and that triggers a bunch of other buy orders. So volume surge are going to happen when the market is extremely high or low and there's a lot of change going on. But the only reason we really have to monitor volume is when we're trading leveraged derivatives. that have contracts that expire. So like the futures market, those contracts expire and it's called rollover. And I always say, if we don't know what rollover is, we're going to get rolled over. So when the volume dries up on a contract and all the big boys have liquidated and we're sitting there trying to trade an expired contract, the spread is going to widen and we get crushed, completely annihilated.
I, as you guys know, am a fan of volume. I think volume, for me anyway, I learned it really from back in the day trading days. Like, I love short-term volume, especially intraday, because you can see when people panic or get greedy. To me, I love it. It's one of my favorite. All right, let me see real quick. I think that's pretty much, that's it. I think we got you covered for today.
Things RSP.
RSP, that's an equal weighted fund. So basically, if I'm not mistaken, the RSP is the S&P 500, but they're all weighted evenly, so it doesn't give any preferential treatment to bias weightings that we see going on right now. Here's my thought on that one, and I'll keep it real simple. While I like that concept better, I think if you're going to put 500 companies together, make them all equal and see how it goes. What I don't like about this is nobody else is watching it. Very few people are. And I want what the retail population are watching, because the levels are going to be forming on the one that the most people are watching. Don, no, I'm not still short. So yeah, I want to watch the ones that's forming that the most people are watching. So I'll look at the actual S&P 500 index, and that's where I base my levels off. Do you trade anything like that, Tillie?
No, I'm a real boring girl. You got S&P spiders, you got options on spiders. So it's like, hey, if you can have a card that can do it all. If you want a little fast movement, you got the S&P micros, and you got the mini contracts and the futures, which there's leverage. Everything is like, it's like one little micro contract is like trading 50 shares of spiders, and at $300 a share, that's a pretty big little position there. And then trading a mini contract is 500 shares. And that's controlling quite a bit of weight, if you will. So, trading with leverage, we don't need to have a really large position to get a high rate of return. And the S&P offers us passive income for, analysis of, those dirty mutual funds out there. They're long the market. S&P is great to analyze those. And then we can use options to earn income when the market is correcting. So I find that the S&P is just the best product in the world.
The best product in the world. Just to drive this picture home a little clearer before we wrap up here with Tillie, here is on the bottom is SPY. That's your market. On the top, you have RSP, which is at equal weighted. And you can see that there's a significant difference in the rates of return for both of these. I'll zoom in just a hair because it makes it look a little more pronounced. So now they're identical. And you notice that RSP is not even close to its all-time highs. S&P is sitting right at it. And that's because of just a handful of a few companies that are overly weighted. Okay? Just overly weighted just a little bit about with that specific market. And it really started the last couple weeks, or a couple months. SPY has just gone ballistic the last couple months, whereas if you look at RSP, it really hasn't. So I prefer, if I was to mentally have one that I like better, I want it even weighted. I'm not one making the market. I don't make the indexes, so I will go with what most people are watching, and that's going to be the actual market itself. All right, Tillie. Let's see what time again we got. So thank you so much. I want to anything you want to promote? Any other classes or your book? I got your book. I haven't read it. Thank you so much. I received the book. I'll be reading it this week. It's my project for the week. I am a slow reader, so it'll probably take me a month to get through it. But I'll finish it.
Yeah, I want to get my feedback from Patrick because I think he actually read the book, and I'm hoping it wasn't too terribly difficult at the end because I really wanted to bring the trading into it and how involved the Fed is. They monitor the position size of the banks. They know exactly what's going to happen when interest rates rise, and I just want people to realize how a controlled market it is. Everyone thinks it's, quote, a free market, if you will. It's open to the public and blah blah blah, but it is really controlled 100% by a few people with a whole bunch of money.
That it is. And they're making themselves richer and richer in the process. All right, Tillie. Well, thank you so much. I always appreciate you coming. We'll probably see you on next week or the week after in your weekend market updates. We do appreciate all you do for us. Thank you so much.
Awesome. Bye, guys.
Bye. Guys, that was Tillie Allison-Harris. She's got a book out called The Fed Effect. I had it on my desk over here. I might have moved on the other desk over there. But The Fed Effect, you can pick that one up at Amazon.com. Of course, if you're in the Kansas City area, she'll be doing physical classes. And if I'm not mistaken, she's going to start to maybe do some online teaching as well. So she'll be one of the online instructors for Online Trading Academy. So that's a pretty cool one. Yeah, I think it's 1 second. I'll even go grab it off my other desk over here. Bear with me, guys. I mean, you got to do gratuitous promotions for your friends, right? That's the book. It's called The Fed Effect from Tillie Allison-Harris. You can pick that one up at Amazon. It's a quick read, 130 pages, but I'm a slow reader, so it'll take me a lot longer than that. Okay, let's see. What else do I got for you? I think what I have to wrap up today's show is simply what happened today and then what's happening tomorrow. I think it is interesting to look at the economic announcements that happened today because they weren't that good. If you looked at Online Trading Academy's Monday Market Must-Knows, you know that one of the things I was focusing on for today was earnings. Now, I'll look at the economic calendar and earnings here. Just as what happened today. The Empire State Manufacturing Index, that was the interesting one for today because we've seen all of a sudden a huge swing back up above zero. Above zero means that you're seeing expansion and optimism in the manufacturing area in the New York Empire State area. It dropped from 17.2. They're expecting 14.6. Now it's 3.7. So that is not great news. I was actually thinking we would see this continue the upside, given more optimism, but not looking so good as we get to 3.7 because at zero means no one's excited or anything about the markets. What else do we have on there? Mortgage delinquencies. You saw that number spike significantly, which is kind of interesting. It went from 4.36% to 8.22. That could also have another potential impact for our markets. That's stuff that came out today. I'll talk about TIC long-term purchases on another show. Here is what we have cooking for tomorrow. Economic calendar for the 18th brings us U.S. only 2 announcements. That's building permits and housing starts. As you guys all know, the housing market right now is in fuego. I mean, housing market's just booming. Of course, when you have that yield down to about 50 basis points, you're getting 30-year fixed mortgages for under 3% or right at 3%. People are gobbling up whatever they can get, which is driving prices up. Other than that, the real main piece for tomorrow it will be British pounds. If you're trading anything to do with the British pound, you do have a lot of inflationary data tomorrow. We'll call it the Magnum PI day. You've got consumer price index, producer price index, or CPI, PPI, and RPI coming out tomorrow for the UK. Let's see, and that'll be happening after the show tomorrow. Here is the exciting stuff for tomorrow. These were all some huge gainers today, guys. Some very big gainers. Walmart, Home Depot, Kohl's, Advanced Auto Parts. Let me just show you the charts of those companies. Walmart, Home Depot, Kohl's, and Advanced Auto Parts. Check this out. WMT. Of course, they're all reporting earnings soon. Walmart today was up 2.66%. For Walmart, it doesn't usually move that much. That's a pretty significant move. You look at, what's the second one? Home Depot. We all know Home Depot because all of us are stuck at home. Home Depot was up 3.5% to 3.6% today. I'll go to Kohl's. Now, Kohl's, you should just be playing taps for this one. I think they are done. What was the other? Advanced Auto Parts. Right, Advanced Auto Parts also was up big today, 1.68%. So a lot of the companies that are reporting earnings tomorrow looking very good today, and some of these other companies will be reporting later on in the week. So an interesting day for those guys jumping above earnings. I will be actually up early tomorrow looking for these ones that are reporting before the market open. Of course, if you're paying attention to the earnings calendars, you can see the BMO there. Walmart, Home Depot, Kohl's, Advanced Auto Parts, and Agilent all reporting, or Agilent's after, but before market open, right? Walmart, Home Depot, Kohl's, and Advanced Auto Parts are all before the market opens. I love those pre-market earnings because a lot of times they will gap right up into a supply level. If they do, I will be looking for that as potential shorting opportunities because I think some of these have gotten really long in the tooth. And it'll be convenient because it'll probably rip us to all-time highs and then pull a little head fake back down below those levels. There you go. All right, and that's it for mañana. What else? I see questions coming through here. You want a hard copy? You got to talk to Tillie about that one. Thoughts on Bitcoin? Yeah, I love it. I'm a huge I'm trying to figure out when to do this show for you guys. I think if I have some time this week, I may actually make my chart of the week, that video I was telling you, which is why Bitcoin will be $100,000 per coin by 2022. To me, that might be a better week, and it should take me a lot more time to produce because there's a lot of facts and charts and animations and graphics I got to put in. So I think might actually do it there as opposed to do one of a show here because my schedule is booked for the rest of the week. Tomorrow we're going to have Justin Krebs on the program. We're going to have David Warner on Wednesday. We're going to have Bob Dunn on Thursday, and then the weekend edition. So a lot of exciting stuff going on this week. Let's see. No sympathy for who? For what? Why is the housing market doing well? It's because cheap money. You have rates are so low. I have friends that are over my house for a barbecue on Saturday, and they're like, "Oh, we just bought a new home." Like, well, are you moving? No, we just bought. We can't turn it down. The deal was just too good. The money is so cheap. I mean, you're getting a 30-year fix right now for under 3% or at 3%. That's the reason. And as far as cryptos go, I'm a huge fan. You guys know I'm a huge fan of cryptos. Not all of them. I think a lot of them are junk. But you saw some big moves out there today. You saw Ripple and Litecoin and Bitcoin, Ethereum, EOS. Those are all companies. Those are all ones that I hold, all doing very well. And I think Bitcoin is going to continue to surge, partly due to the weakening dollar, right? It's no longer a store of value. It's just dropping and dropping and dropping as the Fed will continue to print to help make sure that we do not dip at all before the election. So we have a manipulated market until November. I actually thought that we'd see a little bit more pain in the market, but probably not. I mean, things are looking pretty good right now and no major obstacles other than all-time highs. So there you go. I did say, but I did say by 2021, but I revised. I got to give myself a little cushion. When I did the original presentation, I did it probably 2 years ago, and I said by 2021. I think it could still happen, but I'm going to give myself 1 year extra buffer. You know, I'm not like who's the guy McAfee. I don't know if you guys all saw what John. Did anybody see the crazy statement that John McAfee made about Bitcoin? You know the one I'm talking about. He actually said in an interview. And I think it was, he said, if Bitcoin is not at $500,000 per coin by like 2022, that he would eat his own private parts on air, live. Somehow, I don't want to see Bitcoin at $500,000 because I don't want to watch that in any way, shape, or form. But that's McAfee. He's just a great lunatic. But when you look at the math behind it, I'm hoping I get plenty of time to build it out for you because it's very compelling on why that one will continue to rise and rise and rise and rise. All right, guys, that will do it for me. If you like today's show, you like Tillie Allison, give me a little thumbs up out there. Questions, comments, suggestions, feel free to put those down below the video. I had one question that I didn't get to today, which I really wanted to get to, was sent to me at TraderMerlin.com. I will try to get to that on tomorrow's show when Justin Krebs is on the program. I'll probably do it near the end. So again, that's it for today. We'll have Justin Krebs on tomorrow. If you have any questions, comments, send them in at TraderMerlin.com. You can send in charts there as well, or go to the YouTube page, put your comments down below the video. I'll see you guys tomorrow. Take care.